All right.
Hi, Fiona.
Hey, Mike. Hey, Jovan.
Good morning, everybody, and welcome. I think understatement to say these are unique times, and it's the first time we're doing an entirely teleconference committee meeting with everyone in varying locations. Just a couple of housekeeping items. I think if you do want to say something, let's make sure you say your name when you're speaking, and just an advisory, if there's any members of the public, if you please hold your questions or comments until I acknowledge the time at the end for public comment. Also, if you haven't, I know Courtney sent it out, but all of the board meeting and information is available at the CalHFA website, which is calhfa.ca.gov. So with that, Melissa, I know you called. If everyone's there, do you still want to do a roll call?
I think we're good. Thank you. We have a quorum.
All right. While we get started then, has everyone had a chance to look through the minutes from the November 21st meeting? They were sent out in advance.
Yes, I have.
Thanks, Delilah. Jovan, Fiona. Is there any objection to the minutes being approved as distributed? All right.
They look good.
Hearing none, minutes are approved. As we move to item 3, I just want to mention that it feels like we just had a meeting, which we did a couple of weeks ago. And I think in that meeting, we did do the update of the business plan and the budget update. So I think we kind of have a strong sense of how the agency's doing already financially. As Delilah and I know, Jovan and Fiona, this audit thing, because we have to get information from the comptroller's office, has been delaying this meeting, which typically should have taken place a while ago. But we just got the information, and so the audit could finally be finished. But I think we all appreciate that physically the agency's in great shape, more so than it has been in a while. So with that in mind, I think why don't we jump right into it and move into our audited financials. I think, Mandy, you're on the line here.
I am. Good morning.
Morning, Mandy. And I know Lori is around in the Ethernet as well. So Lori, if we have any questions, is available too. But I think we're going to, unless Lori, turn it over to you and you introduce Mandy and get going. Is that how we want to do it?
Yes, that sounds like a good plan. Good morning, Audit Chair Gunning, members of the Audit Committee, and board members that have joined the call. I am Lori Hamahashi, the CalHFA's comptroller. Today, Mandy Merchant will be presenting to you the results of the financial audit of the Housing Finance Fund for the period ending June 30th, 2019. But before we have her begin, I just would like to go over a few items. First, I would like to mention that agenda item 4C, which is titled the Popular Annual Financial Report, is not part of the audit package and is not currently available on the web link you may have been provided this morning for the meeting. We had just finished or finalized the CAFR on Monday, March 30th, so the PAFR is not yet available. The PAFR is a usable and informative unaudited report that is a condensed version of our 190-page CAFR. Once it is ready, we will gladly provide it to all the members of the board, the audit committee, and whomever may like to see it, and also place a copy on our CalHFA website. Secondly, I would like to add that we will still be able to apply for the Government Finance Officers Award programs for both the CAFR and the PAFR, as we were granted an extension until April 30th, 2020. So shortly after this meeting, we will be submitting the application and the report for the CAFR, and then once the PAFR is ready, we'll be submitting the application and the report for the awards. That was all I had with those items. So at this time, I would like to introduce or reintroduce Mandy Merchant. Mandy is the principal at Clifton Larson Allen in the Pittsburgh, Pennsylvania office, and she previously worked in the Baltimore, Maryland office. Mandy specializes in auditing, accounting, and consulting services for housing authorities, housing finance agencies, and HUD-assisted properties, and has been doing this for the past 19 years. Mandy is Clifton Larson Allen's national leader for the housing authority industry for the firm. Her deep industry involvement includes membership in the Maryland Association of Housing Redevelopment Agencies, Affordable Housing Association of CPAs, and the National Association of Housing and Redevelopment Officials. I just wanted to add that we are grateful to have her and her audit team with us. We can't thank them enough for the time and patience over the last 8 months, as they did start this audit in July of 2019. One last thing I'd like to add is that for the presentation, she will be doing a summary of the other reports that you have access to. So the Housing Finance Fund CAFR, single audit report, and discussions about the communications letter will all be done in a summary format. Okay, and I think that's all I needed to say. Mandy, we're ready for you. Please go ahead.
Thank you, Lori, very much. And again, good morning, everyone. First, I just want to say thank you very much for the opportunity to present the results of the June 30th, 2019 audit to you all. I know, as Lori mentioned, we've been working on this the past 8 months, so we've put a lot of sweat and tears into getting this done. So very proud for this to be ready and presented to everyone. So just to make sure that everyone does have a copy of the presentation, it's a 17-page document, and it starts out on the top right-hand corner with the number 3. So I'm going to use that to refer to it as we go through this presentation so everybody can follow. So, okay, well, I'm going to get started. Great. So I'm going to get started. So let's turn the page and go to page 4 of the presentation. And this is just an overview of CLA. I know some people on the board are aware of us and others are not, but just to kind of give you a little refresher and introduce us. We are the 8th largest firm in the United States. Currently, we have about 6,100 employees of about 120 offices. We have 9 offices in the state of California. We have roughly 50 housing clients, which include housing authorities and state housing finance agencies. We are actually up to about 6 state housing finance agencies. We're auditing now New Mexico and just picked up Illinois. So we're kind of picking up more state housing finance agencies across the country. Overall, 2,000 government clients. We're the #1 firm in doing single audit. And then just overall, as a firm, we have a CLA promise that we kind of promise to our clients and to our employees. So just a quick overview of us. If you turn to page 5, just going back to the engagement team for this year for CLA, it did include myself. We had a new addition this year, Gabby Miller, as a director. She was with the firm for about 4 years, left for a couple years to do some nonprofit work, and then came back to us. So she joined the team this year. Liz Richardson, who's been a senior associate on the job for many years. She's very familiar with the agency. Iffy Nebo, Joey Judson, and Kayla Orris were all the associates that worked on the job. And Joey Judson is our local associate that comes from our Sacramento office. In addition, we had a couple other Sacramento employees that were behind the scenes that we kind of worked with also. Okay, so if you turn the page to page 6, so the CAFR, or the Comprehensive Annual Financial Report, just want to kind of give a couple highlights of what is in that large document that you all have to read. We have the letter of transmittal that was written up by the agency. We then have the GFOA award that is representative of the award that was issued last year for December 31st, 2018, which is included in here. We have the auditor's report, which is the one report in here that comes from us. We have the management discussion and analysis, which includes management's review of highlights throughout the year between the changes of 2019, 2018, and 2017. We have the financial statements and footnotes, the supplementary information, which includes the required schedules based on the pension and the other post-employment benefits. And then finally, we have the statistical and statutory information that's also required as part of this comprehensive annual financial report. So all that information is in that report that we're going to go through at a high level. Okay, next slide. If you turn to page slide 7, we are now going to be looking at the statement of net position, or the balance sheet. Making sure the slide turns. Laura, I'm just looking at the presentation. I didn't see it change. Is there a delay?
No, it should be on page 7 right now.
Okay, sorry, mine must be delayed. Sorry about that. Okay. So looking at the statement of position, as you can see, we have 2019, 2018, and 2017 years presented. That is a requirement when you have comparative financial statements. And we show the change column comparing 2019 to 2018 and 2018 to 2017. We are going to look just at the 2019-2018 column, looking at the increases and the decreases that are in that column. So if you turn the slide to slide 8, you will also now see the liabilities of the statement of that position. Same thing, presenting 2019, 2018, 2017, and showing the changes between those respective years. And now if we change to slide 9, let's talk about some of the details and why there were some increases and decreases between the years. And we're just going to look at the comparison of 2019 and 2018. So overall, you can see there was a decrease in program loans receivable of about $102 million related to the principal payments offsetting any new loans. So there was more pay downs than any than new loans this past year. In addition, there was $252 million decrease in bonds payable. Again, that was made up of early bond redemptions totaling $255, offset by newly issued bonds about $23 million. That's the big ticket items that we saw in here. In addition, there was $82 million decrease in the Federal Home Loan Bank related to the single-family TBA market that was paid down. And then this is not as big as the other stuff, but I just wanted to highlight this, but that the net pension liability decreased $10 million, while the net OPEB liability increased $3 million. And for the most part, this is done by CalPERS. You don't have much control over this, but they, there was a change in the actuarial assumptions this past year, change in the allocation method for the OPEB, and just basically overall performance of the plans in the market. So there's a whole bunch of stuff that comes into play when there's a change in these balances. And then finally, just want to make a note, the swap derivative liability increased $16 million due to the decrease in fair value and lower interest rates in favor of the counterparties this past year. So that's a couple things about the balance sheet. Does anyone have any questions about that on the balance sheet, any of the increases or decreases?
Any questions from board members?
Oh, well, since
Maybe
you're
this is.
Oh, sorry. Go ahead.
Hang on, man.
No, go ahead.
Oh, I was just going to ask about the pension liability. It said decreased by $10 million, while the net OPEB liability increased by $3 million. What does that mean?
So basically how it works is it's two different sets of numbers that are calculated. So the pension liability is based off a different, actuarial report and a different set of numbers that it's derived from.
Okay.
There's actually different, actuarial assumptions. And then the net OPEB in the prior year had been kind of assessed the same way as the pension liability when it was allocated, and this year it was changed up to be allocated based off of a different way. So it was kind of they don't relate. They're separately standalone as you go through it. Even though it's a similar population, they still do different things. Different actuary assumptions are used.
Okay. Okay.
I just
guess-
want to remind the board members to say your name because people listening may not know who, by voices, who people are. Thank you.
Sorry, that was Fiona Moss. Thank you.
Lila, you had a question?
I did. Mandy, Delilah Sotelo. I had a question regarding the swap derivative. The decrease is based on the fair market value and the lower interest rates. How often is that analyzed and evaluated, and how sensitive is that to fluctuation? Obviously given where we are today, but can you tell me a little bit about when that was evaluated for the last term? Or for the last period?
This is Mandy, and I'll just speak from the audit approach. As the auditors, we value it as of 6/30, 2019. So I know internally as an agency, and I don't know if Tim is in the room to maybe speak to that. How often the agency is tracking? I know they're doing it a lot, but I'm not sure I know exactly how often.
We need to do that, and this is Lori Hamahashi. We do the analysis of that quarterly when we produce the quarterly financial statements.
Okay, so the reflective liability is just for the period of time through June 2019, and doesn't reflect anything since then.
That is correct.
Okay.
And Delilah, I can tell you based off some other clients that we saw a lot of swap increase over 2019, especially during the last 3 months. And then after 6/30/19, we actually saw them get even higher and crazy.
Mm-hmm. Yeah, no, this is something for us to watch for. Okay, thank you.
Yeah, I mean, as long as you're not terminating them, it's just a paper entry.
Right.
So, okay, any other questions? All right, well, let's change to slide 10, and let's get into the statement of revenue, expense, and change of the net position or the income statement. And again, we're looking at the 2019, 2018, and 2017 balances, looking at the changes between 2019, 2018, and then the change between 2018 and 2017. And, usually what I like to do is go straight down to the bottom, look at the increase and decrease in net position. And you can kind of you'll see this year there was an increase in net position of about $183 million. Last year there was an increase of about $211 million. So pretty consistent looking at year to year. So let's change the page and go to slide 11 so we can see the reasons for the change of 2019 to 2018. So overall, you can kind of see we just talked about the increase in that position of the $183 million versus the $212 million the prior year. And basically a couple things really happened. $4.16 million increase in realized gain on sale securities due to the 14.1 increase in the realized gains of securitizations. And that's related to, being more active in the TBA market. Also the increase in the changes in fair value, also about $27.5 million. You also had some other income associated with the TBA market. So that was an increase of about $38.2 million. Interest expense decrease, obviously when you're paying off bonds, you're going to have less interest, so about $2.1 million interest expense decrease. And then transfers decreased about $34.7 million due to the decrease in the interfund transfers of those two programs, the HM2 and the HAT funds. And then finally, other expenses increased $37 million due to an increase in provision for loan loss and servicing leasing fees associated with the TBA market also. So a lot of activity in the TBA market that kind of generated some of these increases during this past year. Does anyone have any questions on the changes on the income statement? Okay. Well, then let's turn to the next slide, and this is just a transition slide to get us into the comparative analytics next. So we will flip one more slide to slide 13. And as every year, I do present these 5-year comparisons. And on this slide, we are looking at the interest rate swap, and we are looking at the bonds payable. And this is the liability balances from 2015 through 2019, and these are set up on a graph, a bar graph. So as you can see, as we look at the derivative swap liability, which we expect is that as some of these derivative swaps are being terminated over the years, that you would see the decrease, but you do see that uptick that we kind of talked about previous slide, because even though you guys were getting rid of swaps, you did have an increase in value of the swap liability to the counterparty because of the change in the market conditions. Then we look over to the bonds payable, same sort of a setup, looking at a 5-year comparison on a bar graph. We are seeing the consistent decrease of the bonds payable from 2015 from about $3 billion down to 2019 about almost $1.3 billion, and that is consistent with what we saw during the audit, seeing those bonds be paid down as the program's loans receivable are paid down. So if we go to the next slide, slide 14, which now is a graph of programs loans receivables, doing the same type of a bar graph, looking at from 2015 to 2019, looking at the program loans receivable versus the allowance for loan loss. And as you can see, again, what we like to see from this graph as compared to the bonds payable is that we're seeing a consistent flow of the decrease as the program loans receivables are paid back, the bonds are being paid, also paid down. In addition, you can tell that the allowance for loan loss has also stayed very consistent, not much change in that since 2015. If anything, it's gotten a little bit less, and a little bit of a perk up this year is related to the TBA market.
Hey, Mandy, this is Michael. Explain that allowance for loan loss. Is it 500? I'm not sure I understand the chart.
Okay, so basically what you're hoping to see is to see the allowance each year consistent.
Right.
Because that means that, basically the loan receivable balances on the books has been evaluated to the point that you're collecting it. And if you remember, an allowance under GAAP, there's 2 ways that you identify it, so you determine it. First way is a general allowance. So basically that means it's based on historical activity. So you look at, all right, here's our number, this is a $1 million of program loans receivable, and every year we have to write down or, write off 10%. So basically you have an allowance every year for 10%. The second requirement is specific identification, where you actually look at your loan population and determine what are troubled loans. So basically that bottom part of the allowance is those 2 numbers combined. And as you can see, it's a very small number as it relates to the population. So this is a good chart because it shows even though that your amounts have gotten lower, you're still being conservative. You're not being aggressive and shrinking that allowance. You still have ample allowance out there in case anything, in the event the market crashed or anything like that, you have that reserve there already.
So that 500 million in parens, our allowance is not that much. It's less than that, but you can't really tell. Significantly less. Okay, that's what I didn't get.
Yes, and if you were to go into the actual footnotes, there's a very great footnote in there that kind of talks through, here's the total loans, it gives these numbers in detail, and it will tell you what the actual allowance is.
Great, perfect. Thanks, Mandy.
Yeah. Anyone else have a question? Okay. All right, well, let's turn to slide 15. So next we're going to kind of change up. We're going to go into the single audit report. So since you all received over $750,000 worth of federal awards, you're required to have an annual single audit. So each year we have to look at the federal programs you have and select some for testing. And this year, as always, we tested your Section 8 program. So that is the Section 8 Housing Assistance Payment Program, CFDA number 14.195. And as part of that testing, we do look at several files. So we review how you're maintaining that program, how you're doing your oversight, if you're doing the MORs, if you're verifying replacement reserves, residual receipts, properly paying the participants, the multifamily projects timely. So that's all part of our testing that we do for that program. So during this testing, we did have one finding that was noted this year. It was part of the replacement reserves. And during our review of 8 projects, so we selected a sample of the projects that you oversee the replacement reserves and selected the sample of 8 and looked to see that disbursements were for allowable costs and they were also properly approved. You all do have some projects that require approval not only by CalHFA staff but also by HUD. And during that, we did note 2 out of the 8 projects that we reviewed had disbursements that there was no HUD approval present. So it wasn't they were allowable costs. They just weren't properly approved by HUD as required in the regulatory agreement. So we made it. It is a finding this year, and basically our recommendation is that CalHFA review all the HAP contracts, determine which ones require CalHFA authorization versus which ones require also HUD approval. Does anyone have any questions on that?
Yeah, this is Fiona. So I am reading I guess the correction. Maybe Tia, if you can kind of explain to me what this program is.
So the Section 8 program is the housing assistance payments from HUD's multifamily side that provides rental assistance to certain projects within our portfolio.
Okay.
So we are what you consider what is called the traditional contract administrator for the Section 8 or housing assistance payments. It is not like tenant-based rental assistance. It is basically more akin to a project-based rental assistance. But the development is awarded a housing assistance payment, long-term contract, and it helps support the rental or the operating cost of the project. And so I think we have probably about 68 of these developments that are currently within our portfolio. They've burned off over the years as HUD has transitioned from traditional contract administrator to what we call a performance-based contract administrator. And in California, there are 2 performance-based contract administrators. The Housing Authority of the City of Los Angeles has a nonprofit that acts as their PBCA or performance-based contract administrator, and the Housing Authority for the City of Oakland has a nonprofit instrumentality that acts as their performance-based contract administrator. And so as HUD transitions from TCA, traditional contract administrator, to a PBCA, those HAP contracts are rolling off of our portfolio, and those contracts are now being administered by the local PBCAs.
So is everyone supposed to form a local PBCA, or we're just supposed to go through either LA or Oakland? I don't understand.
So as those traditional contract administration, HUD makes that determination, and it happened about 10-15 years ago, in which they started transitioning from TCA to PBCA. And so this is just a certain type of the HUD financing that helps support multifamily developments. So in the state of California, those are the 2 PBCAs.
That are authorized? Are there more supposed to open?
Well, HUD has been trying to get a new NOFA out as to who the statewide PBCA. They've gone through litigation and they've been trying to get this taken care of literally for over a decade. Hasn't it been over a decade that HUD has been trying to figure out? This has been a fight for a decade as to how they're going to convert and transition the TCAs into PBCAs.
Okay. Thank you.
Mm-hmm.
Hey, Tia, this is Mike. So this is, because I thought you said we're getting out of this program.
We sure are trying to. Well, it has become more and more less efficient for us to continue to administer these contracts. It costs more to run and administer the program than we take in admin fees. And that is largely attributable to the runoff. So the fewer that we have to do, and the fewer admin fees that we receive, the staffing that we have in place to do the work hasn't gone down. So as it becomes more, we have talked to HUD, and when I was in DC in January, February, about a phased transition in which we would send them back the remaining 68 TCAs over the next year and a half, 2 years.
Did they agree to that, or are they just considering it?
They have in part agreed to it. We are figuring out which will go first, and so they've agreed in concept, but which of those developments will be transitioned at which time, that's what we're negotiating now.
Okay.
Tia, this is Delilah. If these 68 projects were to be recapitalized and the project-based vouchers would be extended and or contracted differently, would that take them out of our portfolio and put them into, another program?
If one of the reasons why we were trying to keep the TCAs is because a lot of these projects did need to be recapitalized, and it didn't make sense to separate the administration of the housing assistance payments from being the lender. And so what we're seeing is that as some of these projects are recapitalizing, we have the opportunity to be the lender, but may not be the administrator of the housing assistance payments, which is doesn't make a lot of sense, but that wasn't our decision. That was a HUD decision.
Okay, so if we were to develop a program, a recapitalization program where we would do this hand in hand and propose it and, advertise it to the 68 owners, would that make a difference, or
No,
is it
because
still ultimately a HUD decision?
It's a HUD decision, because we even pitched that to HUD, that by taking these out and giving them to a separate entity to administer the housing assistance payments, it interferes with our preservation plan, because we were trying to build a program around being a lender to recapitalize the deals and to be a one-stop shop and administer that housing assistance payment. So we did make that argument to HUD. They didn't agree with it.
And then, Mandy, my two questions to you are, the reason that this gets a single audit or hits the single audit test is that we're over the 750. What's the dollar amount again? 750 million? No.
$750,000.
Thousand, and we're at 1.5 million. Okay. And then the collective act.
No.
I'm sorry. Go ahead.
I was going to say, no, you're at 50 million. So you'd have to actually look at the schedule of expenditure of federal awards. So that's how much federal awards you have. But I test that program because that 1.5 is the threshold of what I have to test. Anything above that, I have to consider a type A program. I have to consider testing.
Okay, and then the corrective action that you outlined in your single audit report was due in August of 2019. Would you be able to tell us whether that corrective action was actually done?
We would have to ask CalHFA.
Okay.
That's their corrective action plan.
Hi, this is,
So Tia or Kate?
Yeah, hi, this is Kate Ferguson, Director of Multifamily Programs, and that corrective action was taken in August of 2019. We updated our asset management policies and procedures and also put in the requirement that fiscal services ensure that 9250 is included prior to funding any reserves. So I can say for sure that that has been taken.
Okay. Thank you, Mike.
Okay. Any other questions? All right. Well, let's move to the next slide. Let's go to, oh, I'm sorry, one more thing on slide 15. Forgot my last half triangle. Financial statement wise, there were no findings. I'm very happy to report as part of our audit of the financial statements, we did not have any issues that raised the level of needing to be reported in the financial statement. So, okay, so now let's change, let's turn slide to slide 16. So one of the other letters that you all received is the communication to those charged with governance, which would be considered the audit committee. So this slide kind of goes through our auditor's communication, and I kind of laid it out in 3 different buckets. So first of all, it communicates our auditor's responsibility under generally accepted auditing standards. Also kind of goes over the accounting policies, the estimates, and the disclosures that were involved. This past year, as always, if you look at the letter, and you get a chance, there are a lot of estimates that are involved in these financial statements. There is the allowance for loan loss, the other post-employment benefits, the pension. All those are estimates that are derived based on historical analysis, actuaries, and other information that go into the financial statements. Happy to report there was no adjusting journal entries during this past year, and there was no past adjustments. And past adjustments is where we come across an error in the calculation or a number within the financial statements that doesn't rise to the level of being material, but it's to a level where we think it should still be reported, and it's actually not made. We do not have anything like that. So no adjustments, no past adjustments. And then finally, there is a management representation letter that is signed by Tia, Don, and Lori that we received from them. And then finally, other matters, just kind of any other matters out there, just the required supplementary information that we did report on, which includes the OPEB information and the pension information that are required supplementary schedules within the CAFR document. So does anyone have any questions on the auditor communication? Okay, so let's go to slide 17. And this is just, we talked about this last year, what is coming in the future, and there hasn't been too many changes. Actually, just found out the reason I kept this slide in, you are required to implement the lease standards as of right now for starting 7/1/2020. To be implemented by 6/30/2021. And the word on the street right now is that GASB is going to extend this. They have a meeting in June where they're going to talk about it. So right now, I just want to kind of give you an update that the impact might not be felt on CalHFA until possibly 2022. A couple of reasons for that. They were actually talking about it before kind of things came in play with the COVID-19, but a lot of agencies just aren't prepared yet, and the software companies for some of the larger agencies are not ready for it. So if you can think of the leases basically needing some sort of a software kind of similar to capital assets, you know, something that can monitor the amortization of them. Some places with significant leases don't have that ready available yet. So for you guys, the only thing that's really going to impact is that you have the building lease. So the space that you lease in the building would be considered to fall under GASB 87. But
That was
we have
exactly
more
my
time.
question, Mandy.
Yeah.
Yeah, that our only lease is for the office space, I think.
Yeah, it's possibly equipment, copiers and stuff like that could be other possible things, but I'm assuming a lot of that possibly could be immaterial. And we haven't gone down that whole spot yet, but the biggest thing would be the building lease. So, any questions on that? Okay. All right. So if you turn to slide 18, that is my question slide. So if there is anything out there that you guys have questions on, I did just want to say from a high level, just with everything that's been happening the past couple weeks, that most reporting entities have extended almost everything, that they're including for 6/30/2019. So there's been a lot of extensions and filings for the single audit report, obviously for everyone's taxes, but each day another agency is coming out and extending something. So if any of those extensions impact CalHFA or anything coming up, we will be in communication.
Well, Mandy, I know Lori shared with me that because of the waiting for the information from the controller, you guys got to keep extending this audit. So we certainly appreciate you working with the staff and working with us and bearing with us as this thing gets extended. I think we went a month longer than last year.
Yeah.
But thank you.
Yeah, no problem. No problem. It's teamwork, so we prepare for it. We all know when it's going to happen. And during the entire 8 months, I mean, there was constant check-ins on both sides to see how each other was doing. So we were always ready. And then, once we knew it was coming down, we made it all work. So I think it worked out good. It got a little tricky, but we got there. Luckily, everyone was working at home.
Perfect.
So, yeah, and I apologize. I wish we all could be in person. I had a really nice hotel set up. I planned for some dinner, and I'm home now for a while.
Got changed.
Got changed. So.
All right.
And then my last slide, just 19. Just again, overall thanks to the staff. I think we have a great partnership working through this audit every year. We all have the same goal in mind, and whatever needs to be done is done. We spend a lot of time looking at all that information in that report, all those numbers. We really dig in and really look under every rock that there is possible for us to look under. So thank you very much for making it easy for us and getting it to us very timely.
Awesome. Thank you, Mandy. Before we move to public comment, just open it up. Any other board members have questions or comments or thoughts?
No, I just want to thank the staff at CalHFA as well as the auditors for continuing to do work even during this time of disruptions, but thank you very much for producing the financial statements in a timely manner. It is very important that we continue essential state businesses even during this time. So I just want to thank everyone for getting the job done. This is Fiona.
Agreed. Thank you.
Thanks.
Good. With that, then I move on to public comment. This is an opportunity for members of the public to address the board on matters within the board's authority. Is there any members of the public online that would like to comment at this time? All right, hearing none. If there's nothing else, anyone else have anything? If there's nothing else, I want to thank everyone for attending. Mandy, again, thanks to you. Lori, thanks for the work your team does. Certainly appreciate it. And want everyone to be safe out there. And with that, let's adjourn the meeting.
Thank you, Mike.
Thank you.
Mike.
Thanks, everybody.
Thanks, everyone.
Be well.
Bye.